Welcome back to Iron Financial. If you thought the first week of 2026 was going to be a quiet drift into the new year, the market just woke you up. Today, the board didn't just move, the entire game changed. We are witnessing a massive capital rotation in the defense sector, a sector that has been sleepy for years, now fueled by a historic $1.5 trillion promise that is sending shockwaves through Wall Street. At the same time, we have a literal changing of the guard at the very top of the market cap leaderboard, a shift that defines the new AI economy and perhaps signals the end of the hardware era. And while everyone is distracted by the big boards, there is a geopolitical story brewing in the background between Asia's power players that nobody is talking about, but everyone's portfolio needs to be ready for. This is the kind of silent news that crushes margins 6 months from now. Plus, I found a sleeper stock trading under $4 that is flashing technical breakout signals, and 3 quickfire stocks you need to have on your screen for tomorrow morning's opening bell. There is a lot of noise out there today. We're going to cut through it, look at the charts, and get into the data. Let's get to work. First up, the biggest story of the day, the defense sector. If you looked at your watch list today, you saw massive green candles across the board for aerospace and defense. This wasn't a random pump and dump driven by retail traders. This was strictly policy-driven institutional buying. President Trump explicitly stated today that the 2027 military budget should be raised to a staggering $1.5 trillion. To put that in perspective, that is a massive leap from previous baseline expectations. For years, the market has treated defense stocks as bond proxies, slow growth, reliable dividends, safe. Today, they traded like tech stocks. The market reacted instantly and violently. We saw heavyweights like Lockheed Martin, RTX, and Northrop Grumman surge on volume that was triple the daily average. The surface-level logic here is simple. More federal budget equals more government contracts. But here at Iron Financial, we dig deeper. This isn't just about replenishing stockpiles of ammunition or building more tanks. This budget signal is about the Dream Military Initiative. Investors are betting this new money will flow into high-margin sectors, next-generation autonomous wingmen, space-based defense systems, and hardened cybersecurity infrastructure. This move signals that the safety trade for 2026 might actually be in the companies building the safety. However, a word of caution, whenever you see a vertical move like this, you have to expect volatility. If you are already long in these names, watch for a potential pullback tomorrow as day traders take profit. But the long-term trend line? It just got a massive reinforced support beam. The defense supercycle may have just begun. Story number 2. We have a new heavyweight champion of the world. For the first time since 2019, Alphabet, the parent company of Google, has officially surpassed Apple in total market capitalization. This is more than just a vanity metric or a headline for financial news. It is a critical signal of where institutional money is flowing for the next decade. This flip is symbolic of the entire market cycle. For a decade, Apple's hardware dominance, the iPhone ecosystem, and their massive cash pile were the safety net of the S&P 500. Investors flocked to Apple because it was a fortress. But today, the market voted with its wallet. It voted for data over devices. With Alphabet's aggressive and successful integration of Gemini into its ad stack and cloud infrastructure, Wall Street is finally pricing in the AI premium. They see Google as a company that can monetize AI now, whereas Apple is still perceived as being in the implementation phase. Meanwhile, Apple hit a 2-month low today amidst concerns over hardware cycle fatigue. The narrative is shifting from how many units did you ship to how much intelligence do you own. If you hold broad market ETFs like SPY or QQQ, understand that the weighting inside those funds is shifting. The leader of the market is no longer a device maker, it is a data processor. Adjust your mindset accordingly. Now let's go down the market cap ladder. We are leaving the trillion-dollar giants and entering the high-risk, high-reward zone. You want a stock under $4 with legitimate breakout potential? I'm looking closely at Tuya Incorporated, ticker symbol TUYA. Tuya is currently trading right around the $2.11 mark. For those unfamiliar, they operate in the IoT, Internet of Things, space. They provide the essential cloud platform that makes dumb devices smart. If you buy a smart light bulb on Amazon, there is a good chance Tuya is the software running it. Why am I looking at it now? It comes down to market structure. We are seeing a massive volume shelf building up around the $2 level. This acts as a floor, meaning buyers are stepping in every time it dips. As AI moves from chatbots on your screen to integrated hardware in your home, Tuya is positioned as the plumbing for that ecosystem. It's risky. It's volatile. It is a Chinese small cap, which comes with its own geopolitical risks. So please manage your position size. Do not bet the farm. But technically, it's coiling for a violent move. If it can break and hold above the 220 resistance level, there is very little air above it until $3. Keep it on a watch list. Story number 4. This is the news nobody is talking about because they're too busy watching the defense rally. But it might be the most dangerous story of the week. Quiet headlines out of Asia report that China is beginning to restrict rare earth mineral supplies to Japan. This is currently being framed by the mainstream media as a minor diplomatic spat, something that will blow over. But as investors, you need to see the chess move here. This is a potential supply chain shock. Rare earths are the vitamins of modern industry. You cannot build an EV motor, a wind turbine, or ironically, the missile guidance systems we talked about earlier, without them. Japan is a massive hub for high-tech component manufacturing. If they can't get the raw materials, they can't build the components. If this ban expands or sustains for more than a quarter, we could see a squeeze in the materials sector and a slowdown in tech hardware. This flies under the radar because it doesn't show up in a quarterly earnings report today. But 6 months from now, when companies are guiding down because of supply constraints, you'll know why. Keep an eye on tickers like MP Materials as a domestic sympathy play if this escalates further. Finally, let's get you ready for the opening bell tomorrow, Friday, January 9th. We're going to close out the week strong. Here are your 3 quick-fire stocks to watch and exactly how you should trade them. This is your gap-and-go candidate. They just posted a preliminary sales beat, and the stock jumped 9% in the aftermarket. That is a massive move for a medical device company. Here is the setup. The first 15 minutes tomorrow are critical. If the stock opens high and stays there, it means institutions are trapping the shorts who bet against it. We call this a short squeeze. If GBUS holds its pre-market highs, you could see a second leg up as those shorts are forced to buy back their shares to cover their losses. However, be careful. If it opens and immediately starts selling off, filling that gap, it's a trap. Do not chase the green candle. Wait for a flag pattern to form before you enter. The undisputed leader of today's defense rally. But remember the calendar, tomorrow is Friday. In the world of professional trading, Friday is profit-taking day. Traders who bought calls or stock on Thursday's news are sitting on massive overnight gains. Human nature says they will want to cash out before the weekend. Watch the open closely. If LMT dips early but buyers step in immediately to buy that dip, it tells you the conviction is real and this trend is going to last for weeks. But if it fades and keeps fading, it means the smart money is treating this as a one-day headline pop. Do not be the bag holder who buys the top on a Friday afternoon. Yes, the S&P 500 ETF. This is the only ticker that matters at 8:30 a.m. tomorrow. Why? Because we have the non-farm payrolls report. This is the Super Bowl of economic data. It will single-handedly dictate the Federal Reserve's next move on interest rates. The market is currently walking a tightrope. If the jobs number comes in too hot, meaning too many people are getting hired and wages are going up, the market will drop because traders fear the Fed will keep rates high to fight inflation. If the number is too cold, we worry about a recession. We need a Goldilocks number, not too hot, not too cold. My advice? Do not put on any heavy trades until 9:45 a.m. Let the algorithm bots fight it out in the first 15 minutes after the data drops. Once the dust settles, pick your direction. Don't fight the macro tomorrow. That's the deep dive for today. Stay disciplined, respect your stop losses, and let the trade come to you. For Iron Financial, signing off.
The information provided in this video is for general informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.